Let's bring in Deven Choksi, Managing Director at DR Choksi Investment Managers, to talk to us a little bit more about his views with regard to both of these names. Welcome, Deven Bhai. It's always good speaking with you. I want to first start off, sir, by asking you what you make of the kind of rally we've seen on both of these counters. What's your sense like with regard to the core business and the growth prospects? Let me first actually take ports. What's the sense with regard to the ports business?
Yeah, Harsh, good afternoon,
Good
and
afternoon, sir.
thanks for having me on the show.
Our
Uh,
pleasure, sir.
well, I guess I think the port operations domestic, port operations international, logistic operations domestic, and SEZ operations. I think these are the four verticals in which I think Adani Port is operating currently. And each of these four verticals are generating significantly large amount of cash. Interestingly, when you look at, I think, country as a whole, the way in which the port business has been handling the cargoes, FY25 they closed at in excess of 500 million metric tons of cargo handling that they did. And going forward, 5 years from now, they are talking about handling more than 2,000 million metric tons of cargo, which means I think we are talking about 4 times growth over the existing growth which we have seen in this business. Completely, I think, justified as I see it, largely because of the fact that domestically they operate about 15 odd ports in the country, which is connecting the east and west corridors completely. And similarly, I think some of the strategic 7 ports that they have been operating outside the country. So, which is again, I think, strategically connecting the global market from the point of view of handling the cargo. In my viewpoint, I think if they're talking about 4 times growth of cargo handling from now on, I think they are completely justified, largely because of the fact that the trade is expanding, the business is growing. And if you look at the China model of 20 years back, what they actually ended up achieving, I think you would get the validation of this particular number. China, in fact, I think ended up achieving 7 to 8 times or maybe 9 times kind of a cargo handling during this 20-year period, which Adani Port is basically talking about achieving now in next 4 or 5 years. So in my viewpoint, I think we are relatively more game for this particular growth in the country. And this business is also generating free cash flows. That is more important. Around 65 to 70% of the revenue is EBITDA in the business. So I think the company has relatively better ability to invest money back into and further create further capacities.
Do you think, sir, the return ratios are sustainable in this business, can grow from here as operational efficiency starts to kick in? And second, sir, you spoke about how the geographic presence of Adani Ports is solid, but you also have some worries around tariffs. Would that at all, in your view, impact the business?
Well, I think tariff is something which I think everybody is worried about. But I think if you really look into the real sense, I think it's not going to be so. Because everywhere, I think you will find the integration of the business in whichever way you want to have it. A single country cannot have the entire end-to-end manufacturing as we all have understood. So I don't think that one should be unduly worried about the tariff-related situation. It could possibly hamper the trade for a quarter or two, but beyond that, I think again things would get normalized. So I don't think that I think I'm overly concerned about the tariff as a situation in this environment.
And sir, what about the return ratios? Can they build on the operating leverage in your opinion, based on how the numbers are stacking up?
In fact, yes, because I think suppose if we take one example of Mundra Port, which they have, wherein I think they have started putting across the entire operations on an autonomous basis, wherein I think the entire operation of Mundra Port I think is being handled currently without the humans in some pockets. I think this similar situation is also happening with other ports. I think we are counting them into. So from a perspective of keeping the cost structure down and at the same time I think handling higher amount of volume, this is all possible as we have seen in other parts of the world as well. So in my viewpoint, I think be it logistic, be it port business, I guess I think they have the ability to keep the cost structure under control, and so would be the margins, because the margins would be on a higher side going forward, given the kind of strategy location that they have created and given the kind of volume that they are inviting because of the industry's expansion, etc. So I don't see much of a challenge over there. And plus, at the same time, these businesses are always capital-intensive businesses. Initially, you invest hard into the business, and in subsequent period of time, I think you generate equally high amount of EBITDA and make significantly large amount of cash generation as well. So that's what I think these companies experiencing currently.
Okay, so I want to shift the conversation to Adani Enterprises. Now there's just so much happening here. One, from a defense perspective and the opportunity that's opening up for Indian defense companies. This one is decently placed with regard to the defense space. Second, with regard to infra that it does. Third, with regard to solar PV. And fourth, just with regard to the airports business. And there are multiple businesses that they have even outside of this. So it's an incubator of sorts. How should one view the business as an investor? Just how would you view it?
So on one side, you have the complete cash flow generating machine in form of road and airports, wherein more than 7,000 kilometers of roads are already in operation. They're likely to get, I think, more than 10,000 kilometers of roads into operation going forward in next 3 to 4 years time from now. So which means that business is built on operate and transfer basis, wherein I think you are basically getting the maximum amount of advantage of generating the daily cash flow. In fact, the bigger problem should be, I think, how to park this daily cash flow that they are having. So that is the advantage they are having. And similarly, the situation with airport business, wherein currently, I think they are handling about 8 crore plus passengers, I think, which is expected to increase to about 30 crore passengers going forward in next 5 years' time. Again, I think this is a daily cash flow generating business. So daily cash flow generating business is a boon for the company as a whole. Because on the other side, when you have the newer segment of business, which is your data center kind of business, which requires higher amount of cash flow at the same time for investment till 2027-28. In my viewpoint, I think it is justified to have the cash flow generating engine on one side and deploying engine on the other side. So that's what they are doing. Similarly, the situation with the mining business, I think they are generating significantly large amount of output, which is giving them the power to generate more amount of cash in this, and at the same time allowing them to do acquisitions, inorganic acquisitions that they are currently doing. So in my viewpoint, the manufacturing business on one side, the annuity business on the other side, again, I think a good combination of the business model. And at the top of it, I think adding or investing money into renewable segments like green hydrogen, where they're talking about 10 million metric tons of capacity addition in next 4 to 5 years from now. So all in all put together, in my viewpoint, I think it's a balanced portfolio as I see it. And they hold the potential to monetize this portfolio. As I see it, I think the airport and the road portfolios are likely to get monetized, so that at least I think the cash flow comes into the company. Fantastic ability to, I think, generate the best benefit out of this kind of a business model that they are incubating at this point of time.
Okay, and so just from all the businesses that Adani Enterprises is doing, what's the one which excites you the most in terms of potential opportunity and the skills that the group has to execute? So that's the first part of my question, and also give us some thesis as to why.
Okay, so leave aside the trading part of the business for a while, because I think that is their typical legacy that they have. The cash flow generating businesses are probably, I think, the ones which are likely to grow significantly larger in my viewpoint, because of the higher amount of volume that they are experiencing and expanding further into it. So that could possibly become, I think, a more exciting. We do not know yet at this point of time how the data center business and how the green hydrogen business is going to shape up and contribute to the revenue, because I think practically one is short of making a lot of assumptions at this point of time as to what exactly the rollout would be. So from that point of view, I think we'll know. But I think if you ask me, I think what excites me maximum, probably the green hydrogen and the prospects built into it. I think that is what I find, I think, very, very exciting. Maybe the data center business is again an annuity model, but I guess I think the more importantly, green hydrogen business, what technology they adopt, how they exactly convert the seawater into the hydrogen power and green hydrogen power. I think that is something which I would like to see how exactly they will roll out this part. So it is more important to see how they unfold this business, how they implement this business.
Okay, so we'll wait and watch for that. Sir, with regard to debt, this was the other one concern which was there. In your view, has the group brushed that off pretty much entirely now?
So well capitalized as I see it, I think in the past 2, 3 years, I think they have systematically brought in the additional equity by selling the equities to the financial investors. So in my viewpoint, I think it's a good strategy because whatever the debt component, I think which was overhanging at one point of time, today at least, I think as I see it on a consolidated basis across the group, against the free cash flow generation and the EBITDA that they are talking about, the debt is not more than 2 to 2.5 times in every respective situation. Now, for a company of this size and the volume growth that they are handling, which is strategically important assets for the country, I don't think that I think this kind of debt is high. On the contrary, I believe that anywhere else in the world, if you go to, I think they would probably have at least double the size of the leverage than what this company has done. So not concerning at all. Earlier years, I think when they were small, when they were not generating enough amount of cash and deploying hard amount of or hard assets, I think significantly for investment. At that time, situation was different, but today they're generating significantly large amount of cash from respective businesses. So not too much of concern at this point of time. As long as the operations are managed efficiently, it should be seen as a good growth driver for the company or the group.
Thank you so much, Devendra sir, for coming in, speaking with us. Always engaging speaking with you. And this was, of course, a conversation best had with you. So thank you for coming in and speaking with us.